Australia's history is a fascinating story of economic success. From a colonial outpost reliant on sheep farming to a global powerhouse riding the waves of commodity booms, the country has long defied economic gravity. But having experienced an unprecedented 28-year streak of uninterrupted economic growth from 1992 until the COVID pandemic in 2020, Australia's economy is now growing at its slowest pace in a generation and falling behind many of its peers. Real concerns are beginning to be raised about the very foundation of Australia's economic model. Its success over recent decades is based largely on two pillars: commodities and housing. Both of these are highly lucrative, but they also come with risks that could one day send shockwaves through the economy. To understand how Australia arrived at this point, let's take a quick trip through history. Australia has long been associated with natural resources. The discovery of gold in the 1850s transformed the young colony into one of the richest places on Earth. Later, the wool industry took centre stage, fueling wealth and expansion. But it was the second half of the 20th century that cemented Australia's economic identity. The country embraced globalisation, expanding trade relationships, and taking full advantage of its vast natural resources. By the late 20th and early 21st centuries, Australia had positioned itself as a vital supplier of iron ore, coal, and other raw materials, particularly to the rising economic giant far to its north, China. This relationship with China, more than anything else, has defined modern Australia's prosperity. When the world's most populous nation embarked on a historic industrialisation push, Australia was in the perfect position to meet its insatiable demand for resources. Iron ore exports soared, coal shipments took off. The mining boom of the early 2000s flooded the economy with wealth, propelling wages higher and keeping unemployment low. Even during the global financial crisis, while the United States and Europe struggled, Australia sailed through with barely a scratch. China's relentless demand shielded it from the economic carnage felt elsewhere. But after 3 decades of almost unbroken growth, how long can this continue? Australia has tied its success closely to a single sector and to a single trade partner, and in doing so, it faces enormous risks. Commodity markets are notoriously volatile, subject to sudden price swings based on global supply, demand shifts, and speculative trading. This boom and bust cycle makes long-term economic stability difficult. Additionally, coal is facing long-term decline due to global green energy transitions. Separately, China's economy is slowing, its growth model shifting from infrastructure-led expansion to a more consumption-driven system. That means less steel, less coal, and potentially less demand for what Australia sells. And then there's the increasing unpredictability of geopolitics. As tensions between China and the West continue to simmer, Australia's heavy economic dependence on its largest customer could turn into a liability. These are all significant warning flags that a small country of 26 million should be wary of. Then there's the other pillar of Australia's economic miracle, housing. Over the past 2 decades, house prices in Australian cities have skyrocketed, transforming real estate into the country's de facto national obsession. Sydney and Melbourne, in particular, have seen prices reach levels that leave even wealthy foreign investors astonished. For many Australians, property has become not just a place to live, but the primary vehicle for wealth creation. Homeowners have watched their net worth balloon, banks have reaped enormous profits from mortgage lending, and the government has enjoyed steady revenue streams from property taxes and stamp duties. But as with commodities, the risks of an over-reliance on housing are substantial. The Australian economy is unusually exposed to real estate. In total, it accounts for almost 20%. Construction and related industries employ a significant portion of the workforce, while banks have a massive proportion of their lending tied up in mortgages. So what exactly is driving this obsession with property? Well, Australia has a tax system that has some unique characteristics. It doesn't force people to buy investment properties, but the incentives are so strong that they warp investment decisions, and in doing so, distort the economy. Now, I'm not going to go into a lot of detail here. From an economics perspective, I think it's sufficient to say there are very powerful, long-established incentives in place. But I do think a bit of colour does help, so here goes. Australian landlords benefit because, firstly, in most countries, landlords who have to refurbish their properties can deduct the expense from their tax bill as long as they can provide receipts and invoices. But in Australia, landlords are able to deduct non-cash expenses without receipts. They can simply declare the property structure has depreciated by say 5% and deduct that non-cash expense from taxable income. This is like a tax credit and is very beneficial. It is allowed, even though it implies the structure has to be replaced in 20 years when in fact, more often it is sold for a significant profit. Secondly, investors can deduct investment property expenses against their salary. Now, in most countries, these write-offs are restricted to property-related rental income. That means everybody has to pay tax on their salary. But in Australia, if you have a smart accountant, you can get out of paying tax on your day job. This supercharges demand for property because for high earners, real estate isn't just an investment, it's a tax reduction strategy. More demand pushes prices higher, and as prices rise, banks become more willing to lend, increasing borrowing capacity. And that is where the feedback loop kicks in. First, investors buy property, reducing their taxable income. Next, rising property prices encourage more borrowing. Then, with more borrowing power, investors buy more property, pushing prices even higher. And then the cycle repeats over and over. It's easy to see how this system fuels a property boom, as more and more people jump in, expecting capital gains and tax advantages. But of course, this only works while prices keep rising. When the cycle eventually turns and prices start to fall, highly leveraged investors can find themselves in serious trouble, with loans they can no longer afford and assets worth less than they paid. So what could cause the cycle to turn? Well, a shock to the commodities sector would be the classic trigger for an economic downturn in Australia. If China were to significantly cut back on its imports of iron ore, coal or natural gas for any reason, whether it be trade tariffs, an economic slowdown, a shift toward greener energy, or worsening geopolitical tensions, the impact would be felt almost immediately. Households, already burdened with some of the highest levels of personal debt in the world, would become more cautious about spending. Mortgage repayments, which many Australians have stretched their budgets to afford, would start to look precarious. And the once buoyant housing market, dependent on continued confidence and ever-increasing valuations, would begin to show cracks. And then there's the impact on public finances. With tax revenues falling from multiple directions, lower mining profits, weaker consumption, and declining property transactions, state and federal governments could be forced into austerity measures, further dampening growth. Now, this sequence of events may appear contrived, and you may think that economists are pretty useless at making predictions, and that this sequence of ifs, buts, and maybes is too much to swallow. But the truth is that this doom loop is almost inevitable if Australia continues on its current trajectory because of a high level of interconnectedness in its economy. Interconnectedness is making it unstable. The property sector doesn't offer diversification and resilience from volatile commodities. It is dependent upon it. This means that it is likely that a hit to the mining sector would trigger a widespread and dangerous downward spiral. With falling house prices, financial instability, and shrinking tax revenues all hitting the economy at the same time. To provide contrast and an example of how diversification can help, let's look at Ireland. Before the 2008 financial crisis, Ireland's debt-to-GDP ratio was close to 30%, modest by international standards and similar to Australia today. But during the crash, it jumped to over 100% as tax revenues collapsed, welfare payments soared, and the government had to bail out the bank sector to save the economy from complete collapse. Yet somehow, Ireland bounced back quickly, returning to economic growth and reporting a budget surplus in just a few years. How did it manage to do that? Well, Ireland was fortunate, if not unique, as a large part of its economy was driven by multinationals. This meant that while the domestic economy took a beating, unemployment soared, businesses struggled, austerity kicked in, there was still a steady inflow of investment and exports keeping the economy ticking over. The global economy wasn't affected by little old Ireland's austerity measures, and this prevented the Irish economy falling into a full-on death spiral. Now, other Eurozone countries like Greece and Spain weren't so lucky. They didn't have a large, thriving multinational sector to lean on. But they still had enough diversity that limited the downward spiral so that now they are once again thriving, even though it took them considerably longer. However, Australia's model does not appear to be anywhere near as resilient. Rather than diversifying Australia's risk, the property sector is dependent on confidence in strong exports and a strong economic outlook in general. This fragility makes it like a ticking time bomb. highly susceptible to external shocks that could set off a chain reaction of financial instability. Any significant economic disruption has the potential to trigger a dangerous downward spiral. As income from new property deals dry up, market confidence could unravel, leading to a sharp correction that erodes the balance sheets of investors, banks, and even the government. With a substantial portion of household wealth and financial institutions' assets tied to property, a downturn could rapidly escalate into a broader crisis, tightening credit conditions, suppressing consumer spending, and deepening the economic contraction. So to sum it up, Australia is a fortunate country blessed with natural resources, strong institutions, and a highly skilled and educated population. However, an unprecedented boom in its main export customer has allowed serious issues to be forgotten or to grow unnoticed in its economy. Firstly, 50% of its exports are in highly volatile commodities that have blessed Australia with years of growth, but are unreliable for its long-term stability and prosperity. Secondly, 20% of its economy is focused on property development, which has turned into a speculative leveraged bubble due to tax incentives from the government. And thirdly, Australia's economic model is unstable. Years of growth that give the impression of resilience are an illusion. The growth it has enjoyed for so long is based on a virtuous upswing that could at any moment reverse and become a vicious downward spiral. Rather than providing resilience or diversification, Australia's property sector is dependent on mining and the economy in general. Not only will property sector revenues dry up in a downturn, the leverage in the sector has the power to simultaneously destroy the balance sheets of investors, banks, and ultimately the government. It is a classic Minsky moment where years of growth have allowed complacency and sectoral imbalances to grow. So what can be done to address the issues? Well, Australia needs to increase diversification and resilience in its economy by promoting more manufacturing and professional services. Ideally, it should try to identify and promote high-growth niches in technology, green energy, or AI. That won't be easy and it will take time, but any diversification will be beneficial and should be encouraged. And secondly, Australia needs to confront the much bigger problem of unwinding the massive tax incentives it provides to invest in property. Unwinding this speculative leverage bubble has been likened to dismantling a bomb. It will definitely be difficult and dangerous. But just like when a bomb is uncovered, it must be dismantled immediately. The Australian government must immediately act to defuse its property market if it wants to avoid an inevitable crash. A link to the next video should be on your screen now. Just click to keep watching. I hope you enjoyed this video. If you did, then please like, subscribe, and follow. Thanks for watching.